Hello, everyone, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that might not feel as exciting as the latest market rally or the newest crypto trend, but it's arguably one of the most important conversations we can have as investors: emergency funds and cash management. Now, before you scroll away thinking, I've heard this all before. Trust me when I say the financial world in 2026 makes this topic more relevant than ever. We'll cover how much emergency fund to hold in 2026, how investors like you should be thinking about liquidity management, and how to find the sweet spot between security and growth. By the end of this episode, you'll have a step-by-step framework to bulletproof your finances, reduce stress, and make sure your portfolio works for you without putting you at risk when life throws curveballs. Why emergency funds still matter in 2026. Let's start with the basics. We're living in a world of elevated uncertainty. Inflation hasn't disappeared. Central banks are still shifting interest rate policies, and geopolitical instability continues to send shockwaves across markets. So, the old rule of thumb, just keep 3 to 6 months of expenses saved, doesn't always cut it anymore. Here's the thing. An emergency fund isn't just a little rainy day stash tucked away. It's your first line of defense. It's the financial shield that protects your investments, your retirement accounts, and your peace of mind. Without it, you're left with two ugly options when an emergency hits: sell assets at a loss or rack up high interest debt. Neither sets you up for long term success. Life emergencies are non negotiable. The only question is whether you'll be ready for them or blindsided by them. How much emergency fund to hold in 2026? So, how much is enough today? Well, the answer depends on your personal situation, but the guidance has evolved. Let's break it down into three categories. The classic rule, 3 to 6 months. This still works if you have a stable income. Maybe you're part of a dual income household, or you work in a government job with predictable salaries. If that's you, you can lean closer to the traditional 3 to 6 months of expenses. The new conservative standard, 6 to 12 months. In 2026, many financial advisors suggest closer to 9 to 12 months of essential expenses. This is especially important if you're self-employed, a business owner, or in an industry that's cyclical, like construction, tourism, or energy. The high-risk profile, 12 to 18 months. Finally, for those in volatile industries like tech startups, commodities, or crypto, or if you're the sole breadwinner in your household, then having a year or even a year and a half of reserves makes sense. It gives you true staying power. Now, let's zoom out and look at this globally. In countries with strong social safety nets and generous unemployment benefits, you might get away with a smaller fund. But if you live somewhere with expensive healthcare, limited job protections, or inflation-prone currencies, 12 months or more of reserves isn't overkill. It's wisdom. So here's your actionable takeaway. In 2026, 6 months is the absolute minimum. For most people, closer to 12 months is a safer bet. Liquidity management for investors. Now let's pivot from emergency funds into the broader strategy. Liquidity management for investors. Think of it this way. Your emergency fund is about survival. Liquidity management, that's about strategy. It's about making sure you can access cash quickly without wrecking your portfolio. Here are 4 key principles you should be practicing. Layered cash buckets. Divide your cash into 3 tiers. Tier 1 is your immediate emergency stash, sitting in a checking or savings account. Tier 2 is near-term liquidity, like money market funds or short-term treasuries. You can access it within a few days. Tier 3 is investment reserves, brokerage cash, or low-risk ETFs you can tap into if needed. This tiered approach means you're never forced to sell long-term holdings at the wrong time. Optimize cash yield. With interest rates higher in recent years, leaving cash in a 0% account is just throwing money away. Put your reserves in high-yield savings, short-term treasuries, or money market funds. This way your liquidity earns rather than erodes. Avoid liquidity traps. Be careful of so-called liquid investments that aren't actually accessible when you need them. Think long CDs, certain structured products, or niche funds with withdrawal restrictions. Liquidity should mean you can touch it, penalty-free, when life demands it. Mind the tax angle. Liquidity isn't just about access, it's also about avoiding unnecessary costs. Selling assets can trigger capital gains taxes. With a layered liquidity strategy, you reduce the chance of taking a tax hit just to free up cash. Psychological benefits of emergency funds. And here's something we don't talk about enough: the emotional side of money. An emergency fund is more than just a financial buffer, it's an emotional buffer. It gives you peace of mind knowing you can weather storms. It gives you discipline in volatile markets because you don't feel forced to sell investments at a loss. And it gives you confidence to take calculated risks, knowing your downside is protected. In short, cash is both financial liquidity and emotional liquidity, balancing cash and growth. Now let's get real. The biggest challenge isn't deciding if you should hold cash, it's figuring out how much. Hold too much and inflation eats away at your wealth. Hold too little and a single emergency derails your entire plan. So here's a framework. Stability first. Fully fund your emergency bucket before chasing risk. Earning interest. Once the basics are covered, put excess cash in safe, interest-bearing vehicles. Dynamic adjustments. Revisit your liquidity plan annually. Your expenses change. Inflation changes. Your emergency fund should change too. Common mistakes in cash management. Let me also highlight the mistakes I see far too often. Underestimating expenses. People budget for rent and food, forgetting insurance premiums, taxes, or student loan payments. Overfunding cash. Some investors hoard years of expenses in checking accounts, missing out on compounding returns. Mixing funds. If you dip into your emergency stash for vacations or gadgets, it's not really an emergency fund anymore. Not rebalancing. Inflation drives costs up, but too many people leave their emergency fund untouched for years. If you're guilty of one or more of these, now is the time to course correct. Tools for smarter money and AMP, market management. Now let's talk about resources, because your emergency fund is just one piece of the puzzle. If you're serious about building wealth, you need the right tools and the right education. First, let's talk platforms. If you're looking for a cutting-edge, user-friendly trading platform app that complements your financial strategy, you need to check out crystalballmarkets.com. This isn't just another trading app. It's built for investors who want world-class tools with a clean, intuitive interface. It's perfect for managing trades while keeping your liquidity strategy intact. Start trading smarter today with crystalballmarkets.com. And second, let's talk education. Knowledge is your real competitive edge. For beginner-friendly trading, investing, macro, and financial markets podcasts, head to Crystal Ball Markets on RSS. These episodes break down complex financial topics in an accessible way, giving you the context you need to make better decisions. Tune in today and level up your financial IQ. Real-world example: when liquidity goes wrong. Let me share a quick story. Alex and Maria were both investors. Alex put nearly every dollar into equities and crypto, barely keeping a checking account balance. When he lost his job in 2024, he had no cushion. He was forced to sell assets during a downturn, locking in losses he couldn't recover from. Maria, on the other hand, built a 9-month emergency fund. She also held some short-term bonds. When her income paused during the same downturn, she relied on her liquidity. She didn't touch her long-term portfolio. 2 years later, her investments bounced back, while Alex was still playing catch-up. Same market, two very different outcomes. The difference? Liquidity management. The Investor's Emergency Fund Checklist, 2026 edition. Before we wrap up, let me give you a checklist. Grab a pen, or just mentally tick these off. Do you have at least 6 months of expenses saved in liquid form? Is part of your cash earning interest instead of sitting idle? Do you have multiple layers of liquidity? Can you access funds quickly without penalties? Do you review and adjust your cash strategy every year? If you answered yes to all of these, congratulations, you're ahead of most investors. Final thoughts. Here's the bottom line. Your emergency fund is more than just a cushion. It's your permission slip to invest with confidence. Without it, every downturn feels like a catastrophe. With it, volatility becomes opportunity. So in 2026, the best strategy is balance. Hold 6 to 12 months of essential expenses in cash. Build layers of liquidity so you always have options. And use smart tools and educational resources to maximize your approach. Remember, cash isn't wasted capital. It's the fuel that keeps your financial engine running when life takes a turn. Ready to elevate your financial strategy? Explore the Crystal Ball Markets trading platform for world-class, user-friendly tools. And don't forget to tune into Crystal Ball Markets podcast to stay ahead of the curve. That's all for today's episode of Financial Market Insights for Traders. I'm Sophia, and I hope this conversation gives you clarity and confidence in building your emergency fund and managing your liquidity in 2026. Thanks for listening, and as always, trade smart, stay prepared, and keep building toward your financial freedom.